Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by John Bolton, who's the principal of Squirrel Mortgages. Welcome in again, John. Good to see you. We're here, of course, to talk about everything to do with Auckland property. In terms of the housing market, of course, being your key area of focus with your mortgage brokerage business, it's obviously interesting times, as it normally is. We've had these Reserve Bank loan-to-value ratio restrictions in place now for 6 months or so. We've seen all the figures coming through. Just be interested in your take really on what impact they've had on the market.
Yeah, sure. Well, I think the market, it's being reported now, is down about 20%, and we've certainly been feeling that since probably around February or March, which is that sort of 6-month window that the banks had to introduce the LVR restrictions, and then from there on in, it really has sort of started to bite. Not necessarily a bad thing. The banks clamped up a lot harder and faster, I guess, than the Reserve Bank was expecting. But since sort of March, April, we've found that the market slowed down, and the banks now can comfortably handle the above 80% business that we're putting into them. So we're not getting nearly as many declines as we were at the start of the year, and I think that's just a symptom of the market slowing down. So the LVR restrictions are there; they're doing their job. They've definitely contributed to slowing down the market, along with 2 OCR increases, the prospect of further OCR increases, and the other thing not to forget is that we've got an election coming up this year as well. So when you kind of look at the whole mix, you've got the OCR going up, you've got an election that's looking less and less obvious in terms of what the outcome will be. And you've got these sort of LVR restrictions, and then you've got a lot of commentary in the market sort of talking about what potential impact all of these things will have on house prices. And it's that uncertainty around house prices, I think, that really slows the market down. Housing's a confidence-driven market. What we saw in 2013 was a lot of speculation, a lot of people just jumping on the ladder as house prices sort of escalated. What we're seeing now is the reverse of that, which is people being a little bit more cautious, a little bit less certain, and potentially sitting on the fence a lot more just to sort of see how this market shakes out.
So you mentioned a key word there for me, uncertainty, and obviously markets hate uncertainty. And you mentioned too, when we were just chatting off camera when you arrived, that it's pretty slow out there. Obviously sales volumes in Auckland are down sort of 20-21% year on year.
Yeah.
You're obviously the median price has still been rising or holding, but you see that following sales volumes down as well.
Yeah, look, it's an interesting one. I think there's definitely some softness in house prices. The interesting thing is that a lot of the metrics that we have don't really give us any clarity in terms of what's really going on. Last year we had a lot of people that were renovating old houses and then selling them back into the market. So they were potentially buying them cheap, selling them high, and those sort of things drive the statistics quite a bit. What I think we can see in the market at the moment is where a house is really well marketed and it's the right property, there's store market there for it, and a good property on the right day will still get a high price. But what we're starting to see is houses falling through the cracks, houses that aren't marketed well or aren't presented well to the market, houses that have got problems with them, maybe a code of compliance problem or something like that. And those properties are definitely selling cheaper than they would have last year. So that softness is starting to come through, and I'd expect to see that continue to get a bit of momentum through the winter, which is traditionally a quiet period, particularly going up to the election. I think it's safe to say that sort of August, September, October is going to be probably quite quiet in the housing market. And if the sellers are there and the buyers aren't, then that softness will definitely come through.
So there'll be an interesting little period running into the election. You obviously you've dealt with deal with a lot of first home buyers, would-be first home buyers. How are they faring now?
Well, I think the ones that are rational and don't get sort of too nervous about the market and kind of understand what's going on tend to stay in there and continue to look. So we've still got a reasonable chunk of first home buyers out there, probably taking advantage of a bit of softness in the market at the moment, less competition and stuff, and feeling like there's an opportunity to buy, whereas perhaps in 2013 there wasn't. It was just crazy, and maybe pick something up at a sort of what they might consider a more sensible price. So that's still going on, but there's a lot of first home buyers out there now who I think are just lacking confidence, and are definitely back on the fence. And look, that's not necessarily a bad thing. You know, we've got a big driver of that's a rising interest rate environment, just how that plays out, and certainly, you know, earlier in the year and late last year, the speculation was that, you know, mortgage rates would be 8% by the end of this year or early next year, and clearly that's not the case. But you know, that certainly sort of impacted that market and got them, I guess, checking in and making sure that they could actually afford it. So it's a bit of a mixed bag. I think it's certainly a confidence-driven market, and my view of what will happen is for the rest of this year, it's going to remain pretty soft. People really are going to sit on the fence. There's too much uncertainty out there. There's always sort of naysayers, and there's always people talking into your head about everything that can go wrong with property. Equally, there's people that get overly enthusiastic about it. This year it's going to stay soft. There's just too much uncertainty with elections, with OCRs, with LVR restrictions, with the prospect of softer house prices. We'll get through this year. Going into next year, I think you'll probably see things settle down a bit and you'll get a bit more of that confidence coming back into the market. The thing with first home buyers is that they do tend to jump in and out of the market en masse. And when they do jump back into the market en masse, you get a bit of momentum going again, the confidence builds, and you'll probably get another surge. You know, the reality is that, and I think Tony Alexander from the BNZ was pointing it out, that, you know, at the end of the day, we've still got strong immigration coming into the Auckland market. So there's this kind of odd situation where we've got potentially a bit of softness coming through in the housing market at a time when we've actually got really strong immigration. I think that immigration factor will kick in again next year.
Now, you mentioned interest rates. Obviously, Reserve Bank has so far increased the OCR twice this year. We're expecting another increase next week. So obviously floating rates are going up, and some of the 6-month, 1-year fixed rates have been going up, but the 2-year to 5 years, we've actually been seeing them coming down. Obviously that's due to swap rates and other factors driving bank funding other than the OCR, but that creates an interesting dynamic. What are you seeing in terms of customer desires between floating and fixing, and what they're thinking about all that at the moment?
Okay, so there's two things going on. So the first is obviously we've had the increase in OCR at the short end of the curve, which has been driving up the swap rates and the bank bills. But at the same time, in a low growth environment, the banks are competing away margin. So bank margins are probably the lowest that I've seen them in 4 or 5 years now. So literally banks have absorbed the increasing wholesale interest rates. And ironically, you know, some of the rates that we're seeing at the moment are more competitive than they were before the last OCR change. 2-year rates down to 5.75, 5.8, where they were around 5.95 before the last OCR change, so odd. That's a function of low growth market and a lot of banks competing aggressively for growth. You know, some of these smaller players that have sort of come into the market more recently, so your TSB's back in, competing, you know, aggressively. You've got SBS Bank, you've got Kiwi Bank that's always there competing against, you know, the big banks. In a low growth environment, not all of the banks can win. So you're going to see sort of quarters where banks are going to be losing market share, or potentially even their books will be decreasing in size. And that's going to keep the competitive pressure on those sort of 2- and 3-year fixed rates. I think if there's another OCR increase to come through, maybe in June, or if not in June, then at the next announcement, realistically, these margins have come down to a level now where the next OCR increase is definitely going to get passed through in the rates.
In what term rates do you see that being passed through?
I think the 1, 2, 3 year, the short end of the curve. I think the margins have been competed down to a level that any further increase in wholesale interest rates will definitely pass through to those customer rates. At the long end of the curve with your 4 and 5 year rates, that's been driven by offshore events, and I guess wholesale swaps have actually been decreasing out there. That's just a function of, I guess, the world generally, and even in a New Zealand context, thinking that rates will stay lower for longer. That all of our ills haven't been solved, which I think we've talked about before. And hence, those rates have pulled back a bit.
And just in terms of the level of competition between the banks, I mean, are they still prepared to give, decent discounts to their carded rates for good customers, that type of thing?
Well, look, there's not really, not around that 2 and 3 year mark. I mean, the rates at that point now are so competitive and the margins are so tight there that pretty much the best rates that you see advertised are the best rates available for that term. Out at 4 and 5 years, where the bank margins are a lot bigger, I think there's more room to negotiate. So, maybe 3 or 4 months ago you could get 30, 40 points off, or as much as 0.5% off some of the carded rates. I think that's less of a reality now. That said, if you look at the carded rates across lenders, you'll notice that there are some big differences there. As a rule of thumb, I think you can generally expect to be able to negotiate a bank down to the best of its competitors. It's a very competitive environment. The banks are very focused on retention. They're certainly not wanting to lose any clients. So they're pretty much going to match anyone else in the market.
Now, another thing I was keen to ask you about is the types of house sales that you're seeing. Obviously, auctions have been really the way that a lot of houses have been sold in Auckland in recent years. With this slowdown in the volume of sales, have you seen a slowdown in sales via auctions?
Yeah, not a huge drop, but it's certainly a decrease from where it was last year. I mean, we've definitely got a lot more of our buyers, and particularly the first home buyers, coming in with houses by negotiation. So I think even failed auctions and then potentially negotiating sort of post-auction. The reality is that auctions are a very expensive way to buy property in terms of having to do your due diligence up front. And it's always going to be a buyer's preference to be able to buy by negotiation. It's a lot cheaper, especially for first home buyers. And we are seeing more of that. I mean, it would be great if there was even more price by negotiation. As we get into winter, and as more and more of these auctions do sort of trip over, I think you'll just see a continued trend towards price by negotiation.
Now, another thing I wanted to ask about is the supply of housing and land for housing. Obviously, you do some development as well. We've had this Auckland Housing Accord obviously in place for a little while, and last week we had the Housing Minister Nick Smith and Mayor Len Brown sort of talking up how they're on track to exceed their first year target. Obviously, then we had Labour, the opposition party, obviously hoping to be government, talking it all down and saying you can't live in a consent and things like that. What are you seeing out there on the supply side?
Do you really want to know?
Yes.
Oh, look, it's a lot harder than you think, and we could have an entire session just on property development. Land prices in Auckland are still very high, and I think unrealistic in terms of for development. There's just no margin in the development itself because the land prices are so high. The interesting thing that I've sort of seen more recently coming out is this sort of feedback from developers that we need to build more shoebox apartments and stuff. Which to me seems to be a knee-jerk reaction to what's really going on. The idea being build smaller and smaller apartments because you can sell them for a higher per square metre rate and therefore make a bigger margin or a bigger profit. What that's kind of telling you is that the profit margin isn't in there for development, and so developers are struggling to identify properties that they can develop at a margin that makes it worthwhile, and that's a reality. But to simply resort to building smaller and smaller apartments, to me, isn't the answer. I think there's a number of issues, and they're touched on sort of all over the place, whether it's the sort of monopolistic type suppliers that we've got in the construction industry. It's the banks in terms of their ability or willingness to fund development. And one of the big issues that we've got here is that New Zealand's really just a collection of small developers and builders. We don't really have any scale outside of the likes of Fletcher's. And with that lack of scale, your actual costs are a lot higher, and that's not just that's not just building materials. It's like compliance with your bank covenants. It's the ability to get bank funding. Often for smaller developers, a bank's going to force them to put a head contractor over it. And a head contractor is going to want a margin, so you end up with margin on margin on margin, and all of these things sort of create an environment where it's very, very difficult to build. And I think we've still got that. I mean, there's certainly plenty of opportunities to buy land. Whether you can buy it at a value that makes it economically viable is maybe a different question. And I think there's still a risk here that you've got a lot of people that will buy land speculatively with no intention to develop it themselves. But then
land bankers.
Basically land bankers. And they have no intention to develop themselves, but the problem is that the economics are so stuffed that there's no real opportunity for a developer to then come in and develop it. So... yeah.
Well, thanks for that, John, and we'll definitely talk more about development in the future. That's John Bolton from Squirrel Mortgages, and I'm Gareth Vaughan at interest.co.nz.